All right, welcome everyone. Today we're going to pull back the curtain on something we use every single day, but let's be honest, rarely think about money. We're going to explore how it's created, seemingly out of thin air, who's pulling the levers behind the scenes, and, most importantly, how all of this directly hits your wallet and the entire economy. So let's dive right in. So, here's our game plan. We'll kick things off with the big question: what even is money? From there, we'll get to know the powerful institution in charge, uncover the banking system's biggest, well, magic trick, and then wrap up by looking at how this whole economic engine is actually steered. Should be fun. Okay, first things first. Why do we even need money in the first place? I know, it sounds like a super obvious question, right? But to really get a handle on the system, we've got to start with the basic problem that money was invented to solve. Just imagine this for a second. You live in a world with no money. You're a fantastic baker. I mean, your bread is legendary, but you need a new pair of shoes. How on earth do you make that trade happen? Well, this leads us right into a system called barter. And let me tell you, it's got one giant inefficient problem. So you'd have to go out and find a shoemaker who not only has the exact shoes you want, but who also happens to be desperately craving bread at that very moment. Can you imagine the time you'd waste just trying to find that one perfect person? It's crazy. And this, right here, is where money steps in as this beautiful, elegant solution. You see, money is really just the tool that we all agree to use to make our lives easier and transactions smoother. And it can be pretty much anything, honestly, as long as it does three absolutely crucial jobs for the economy. Okay, so what are those three jobs? First, it's a medium of exchange, which is just a fancy way of saying you use it to buy stuff. Simple. Second, it's a unit of account. It gives us a common yardstick, so we can put a price tag on a car or a loaf of bread, and it means the same thing to everyone. And third, it's a store of value. You can stick it in the bank today and know it'll still have purchasing power tomorrow. Now, what's really interesting is that money comes in two main flavors. You've got commodity money on one hand. This is stuff that has value all by itself. Gold is the classic example, right? But then you've got what we use today, fiat money. Think of the US dollar. It's really just a piece of paper, but it's valuable because the government says it is, and, crucially, because we all believe and trust in that promise. Okay, so if the money we use is basically built on trust, who's in charge of making sure that trust doesn't, collapse? Who manages the whole system to keep it stable? Well, that leads us straight to the Central Bank of the United States, the Federal Reserve, or, as you've probably heard, the Fed. So the Fed has this interesting structure. There's a board of governors headquartered in Washington, D.C., and then there are 12 regional banks spread all across the country. But the real powerhouse, the group that makes the huge decisions about our money, that's a committee called the FOMC, the Federal Open Market Committee. And the Fed really has two main jobs. First, they act as a kind of watchdog for banks, making sure the whole financial system is healthy and sound. And second, and this is the big one for us today, they control the quantity of money available in the economy, the money supply. This is huge. All right, and this is where things get really, really interesting. This is probably the most surprising part of this whole story. See, most of us think that banks are just these safe places to store our money, right? Like a vault. But they do something way more powerful than that. They actually create new money. And the key to this whole magic trick is a system called fractional reserve banking. It's actually a pretty simple idea, but it has absolutely massive consequences. And the entire thing is built on one simple bet. A bet that not all of us are going to show up at the bank and ask for all our money back at the very same time. Let's just walk through a quick example. So, you deposit $5,000 into First National Bank. Now, the bank is legally required to keep a fraction of that on hand as reserves. Let's say the reserve ratio is 20%. So they keep $1,000 in the vault. But what about the other $4,000? They loan it out. And boom, just like that, you still have your $5,000 deposit, but now there's also $4,000 of new money in the hands of whoever took out that loan. The money supply just jumped to $9,000. Oh, but wait, it doesn't stop there. Not even close. That person who borrowed the $4,000, they go out and spend it, and whoever they paid deposits it into another bank, say Second National Bank. Now that bank does the same thing. It keeps 20%, that's $800, and loans out the rest, $3,200. Bam, more new money just appeared out of thin air. And this process just keeps going, rippling through the entire banking system. This is what economists call the money multiplier, and it is incredibly powerful. With that 20% reserve ratio, our single initial $5,000 deposit can end up creating a total of $25,000 in the money supply. It's wild. Now, of course, in the real world, it's not quite this clean. Sometimes banks hold extra reserves or people stuff cash under their mattress, but this gives you a perfect idea of the incredible potential of the system. So, a good question at this point is, if banks can just create money like this, what's to stop the whole system from just spiraling out of control and causing insane inflation? Well, that's exactly where the Fed comes back into the picture. They've got a whole toolbox of powerful instruments to manage this process. Okay, tool number one, and this is the big one they use all the time: open market operations. It sounds complicated, but the idea is simple. When the Fed wants to increase the money supply, it buys government bonds from banks. And how does it pay for them? It just creates the money, crediting the bank's accounts. That's new money injected right into the system, ready to be loaned out. And if they want to shrink the money supply, they just do the opposite. They sell bonds to the banks, and that money effectively disappears from circulation. Next up in the toolbox is something called the discount rate. This is basically the interest rate the Fed charges banks when they need to borrow money directly from the Fed. So if the Fed lowers this rate, it's like putting on a sale. It makes it cheaper for banks to get extra reserves, and that encourages them to lend more money out to you and me, which, you guessed it, increases the money supply. And last but not least, the Fed has a really powerful, though less frequently used tool. They can change the rules of the game itself. They can actually adjust that reserve requirement we talked about. So imagine they lower it from 20% down to 10%. All of a sudden, banks can lend out way more of every single deposit, which cranks that money multiplier up to a whole new level. So why does any of this matter? I mean, really, why should you care about open market operations or reserve ratios? What's the bottom line for you? Well, it's because every single one of these actions has a direct impact on your financial life, your wallet. At the end of the day, it all boils down to interest rates. See, the Fed uses all those tools with one main target in mind: the federal funds rate. Now, that's just the interest rate banks charge each other for overnight loans. But you should think of it like the bedrock, the foundation for all other interest rates. When the federal funds rate moves, you can bet that the rate on your mortgage, your car loan, even your credit card, they're all going to follow suit. And this control becomes absolutely critical in times of crisis. When major uncertainty hits the economy, think about early 2020, the Fed can step in as the lender of last resort. They make sure banks have the cash, the liquidity they need to prevent the entire financial system from just seizing up. Okay, let's wrap this up with a fun little thought experiment. Forget about all those complicated government bonds for a minute. Imagine the chair of the Federal Reserve buys a couch, just a regular old couch, from a friend for $1,000, and they pay for it with a check drawn directly on the Fed. What just happened to the money supply? Well, the answer is the money supply just increased by $1,000. That's right. The second that check gets deposited, brand new money enters the banking system. And this really drives home the immense, almost unbelievable power of a central bank. Which leaves us with one final and pretty crucial question to ponder. If the Fed can literally create money just by buying, well, anything, what's to stop them from printing it endlessly?